Good morning, everyone. I can see a few people still joining us, but we're going to respect everyone's time and get started. Thank you for being with us today. My name is Ashley Brown. On behalf of KLR Wealth Management, I wanted to welcome you to Investing and Financial Planning in the Post-COVID-19 World. We have David Wray here, our Chief Investment Officer, who will be kicking things off today by giving you a quick update on the current state of the economy and the financial markets. And we also have Peri and Aptaker, our Managing Director, who will be reviewing some of the financial planning challenges and opportunities facing investors right now. And then we will open it up for questions. So we received a number of questions from folks when you registered, so we will be addressing those. And you can also submit them through the GoToWebinar control panel at any time. Also, just a quick reminder that we'll be sending out a link to a recording of today's session if you want to go back and view it via email afterwards. So without further ado, I'm going to turn it over to Peri and David.
I guess that's my cue to start. Good morning, everybody. I think we've got people from all time zones across the country, so a special good morning to the very early people on the West Coast. But really, thanks to all of you aboard who are our clients. Your loyalty and your confidence in us is much appreciated. I know Peri will say exactly the same thing when I turn it over to her in a short bit. There is a lot I could talk about. I mean, I think people who've heard me speak before, and on a prior perch, I spoke quite a bit. I used to say, sort of laughingly at myself, that I could look at my watch and would say 10:02, and I would inhale, and at 12:02, I could exhale, and I will think I've been fascinating. Now, I don't have that kind of 2-hour time. In fact, I've been limited to 20 minutes, and I'm going to try to do these 20 minutes justice, and maybe even cut a few aside from that, because I really do, and Peri will also say this, we really are looking forward to your questions. The ones that have been submitted are outstanding, and others that might occur to you would be terrific. So thank you. So, you know, investment strategy, I'm the Chief Investment Officer responsible for investment strategy, directing the asset allocation directions on every portfolio, every nickel that's entrusted to our care, and also considering the investment assets that are held away from us is often a part of what we do. So what is investment strategy? Investment strategy at its base is trying to determine returns going forward within each and among every asset class, you know, relative in an absolute term, but also comparative to each other. And there are many factors that go into this. And, you know, this is an introduction, but it's not a long one. You know, the first, you know, certainly the markets themselves, you know, what are going to determine returns for stocks, for bonds, for commodities, for alternative asset classes. And what are the inputs? I mean, the prime input is almost always, and over the long term, it's economics and only economics. You know, what are the prospective long-term economic environment that we're going to find ourselves in? Over the short term, there are certainly other impacts, and we're certainly being affected by the big one now. You know, the markets themselves actually provide a significant source of signal. Often the markets provide a lot of noise, but more often than not, the markets always have a signal to them that is useful in understanding to project returns going forward. Economics, of course, is vital. And then on occasion, there are the political environment, and maybe there'll be a question about that later, or the geopolitical environment. Oil, gold, the prime commodities often provide signals. And then once in a while, there's that dreaded other. And other, of course, right now is the virus. And right now, from a market standpoint, from an economic standpoint, everything is all about the virus and only about the virus. So I will come back to that in a moment. First, I just wanted to sort of get through a couple of these others first. First, politics, geopolitics, oil are just a sideshow right now. I know there was in March an effort made by the Saudis and the Russians to basically undercut the oil market and so forth, and it provided a little bit of market noise, if you will, overall risk asset market noise. But it's a sideshow right now. We can essentially ignore it. The markets themselves, lots of signals, but I think they're now more noise than they are signals. We had a 35% drop. I would regard that as a PG rated, not an X rated slasher or R rated slasher, but a PG rated bear market. The markets going into mid-February, in my opinion, I've been writing about this for a long time, were due for a baby recession, baby bear market. Essentially, the markets and the economy needed a reboot. Now, who knew that we were going to get a reboot in the form that we're getting it now? But in my opinion, studying the economic cycle and just studying the internals of the markets, they badly needed a reboot, and we're getting it. We've gotten it to a large extent, but there's still work to go. But the markets provide a lot of internal signals that I think have been fairly specious lately. We had a 35, sort of a very synchronous in terms of percentage. We had a 35% drop, followed by a 35% recovery. Now, arithmetically, that still took us, well below the prior high. But there was sort of an interesting synchronicity, whatever that word is, to that. Now, over the course of the past few days, to include this morning, we've given up quite a bit of that. And again, I think that's makes this call particularly more timely. So the markets themselves provide a lot of signals. Certainly, the economy is brutal right now. There is just no question about it. Everybody knows that. It's in the market. It got priced into the market as of the low on March 23rd. I have a zillion metaphors, but I'll use this. On March 23rd, at a low of around Dow 18,000 and S&P below 2,200, we were not just pricing in what we knew or what we thought we knew. We were pricing in what we thought we might know sometime. 8 shoes to drop, even if only. And so from that low, even if only 2 or 3 shoes that we don't expect drop, that low, which I'm very confident it was in, March 23rd, will prove, in my opinion, to be the low for this particular bear market environment. We'll all find out later or not whether that's the case. But the economy is brutal, and I'll spare you the data recitation, except just to comment on the unemployment number. Last week, the unemployment number was 20-odd million people had lost their jobs, an official unemployment rate of 15%, but that's understated it. It's really closer to 20. And then this morning comes the news that another 3 million people in the current reporting week have now gone out of work. So that number is just going to keep going down and going down for a while. I couldn't even begin to tell you, because the jobs data is notoriously a lagging indicator when that will stop. But suffice to say, this is the worst economic environment that we've had. The question then becomes, of course, where are we going? And I'll come back to that in a moment. So, the sideshows from oil and geopolitics and so forth, market signals, the economy. So that really takes us back to other. And it's really all about the virus. And here again, I'm not saying anything that you can't hear 400 times on every cable news station of whatever whatever persuasion it might be. That nobody really knows where this is going. I mean, the genie's out of the bottle. How or why it got out, it doesn't make any difference from the market's point of view. The fact is that it's out. There's always a high degree of uncertainty over anything that any factor that will affect the markets going forward. But I don't think there is anything as uncertain as that I've seen in my now 40 years of professional in this profession. To rival this. There is no certainty about the timing or the magnitude. It is totally out of the virus will do its own thing in its own way. Policymakers can want something to be true and try to force something to be true, but its truth will only be known in the end of this. And hopefully, for all our sake, it'll end sooner rather than later with either a very, very successful and widely available treatment and most certainly a vaccine. But that again will be left to we'll all have to find that out later. So we're in a process here now of certainly of great uncertainty. That goes without saying. And now, so our objective with our client portfolios is to position them accordingly in the environment that we have. It would have been actually, if we'd done this call a week ago, with the Dow and the S&P and certainly the big high tech stocks making highs, it would have been, and many pundits out there would have been very tempting to say that the all clear signal is imminent. The S&P's return to 2950 and the Dow's return to well above 24,000 were, in the market's eye, a clear signal that things are going to get better. Now, our opinion has been all along that with the markets were being boosted primarily. There was the hope of the backstory behind it of an economic reemergence, but basically the markets were being boosted by a massive economics and fiscal and monetary stimulus. Like the Federal Reserve has injected tons of money into the banking system through its purchases of credit instruments, high yield, investment grade corporates, treasuries, and even high yield bonds. But almost more importantly, the stimulus checks, the checks that have been distributed to individuals, to businesses through the CARES Act, through PPP, perhaps there will be another stimulus package, has injected massive amounts, unprecedented amounts of money into the system, for which the economy has, frankly, no interest in doing it. Just because a state says it's reopening parts, the restaurants or other parts of sort of the broad consumer-based economy doesn't mean anybody's going to be significantly taking advantage of it. And so we end up with lots of money in the banking system with an economy that doesn't care. Well, the markets are only too happy to, provided that there's a catalyst, a fundamental backstory, economic backstory of improvement, or even improvement, of course, in the major factor of all, in the virus. And there's certainly been stories about Gilead's remdesivir and potential vaccines that are being tested by Lilly and by other companies. Moderna, I think, is a Massachusetts-based company that has some vaccine work in effect that has, according to some, has promise. We'll all find out later. So there has been a backstory that has been very seductive, that the economy will come out of this sooner rather than later. And so we had this 35% upside reversal. So when I wrote my monthly update, I think everybody here on the call has received at least a link to it. Hopefully and potentially you read it as well. It sort of called into, not called into question the potential. Anything's possible. I'm the most optimistic guy in the world, or I wouldn't be in this business, frankly, because forward returns are something, and I'll come back to this later. I think in response to a question, if I don't get to it before, about the potential really positive things that can happen over the next several years once we get through this. But sort of the immediacy is, even if we get an economy that normalizes, what will normal look like? There are all sorts of letters that have been ascribed, and those of you who are sort of, geeky, nobody's as geeky as I am when it comes to financial markets and economic analysis. At least if you are, you and I will have a wonderful time talking about it. But there are all sorts of letter alliterations to what this economy will look like. We've had this big drop. So will it be a V, where there's an immediate return and an immediate return back to normal? That's a possibility. There's a W, where you go down, you bounce up, you come down, bounce up, and maybe even a series of W's. There was a common pundit on CNBC this morning talking about that. Actually made a very compelling case. Then there's the U, where you get this sort of bowl-shaped, more elongated drop, but then you come back out with a fairly sharp rebound, which was actually not quite as positive as the V, but a V, but a very positive one. And then, of course, there's the dreaded L, where you go straight down and you flatline for a horribly extended period of time because there's just no getting around it. And that would be terribly bearish. So there's all sorts of discussion about that. I will say I'm more inclined towards the W, meaning that the economy will have this massive bounce down, or is having it right now. With the reemergence, there will be some gain back, nowhere near to the level that we were, but some reestablishment of growth that will make some folks be excited. But again, the virus is going to operate on its own terms, and just because an economy is starting to come back from a deep trough doesn't mean that it can get anywhere back to normal, what we would consider, let's say, a $20 trillion GDP, which is what we were annualizing anytime soon. The Economist ran, for those of you who might see The Economist, which is an outstanding magazine produced in the UK, ran a cover called The 90% Economy. And I find that, very tempting. Again, that sounds very simplistic. What's the economy going to look like? Clearly, it's going to change. There will be jobs that will not come back. I think I've always used the metaphor of, back in the economy that we knew in February, we created one with too many barbershops on the same street. There was only enough for two to do a land office business, three to do a good business, but with all the tax incentives and optimism, barbershops 4, 5, and 6 came along. And clearly, in this kind of environment, then barbershops 4, 5, and 6 are going out of business, and there's just no two ways about it. The economy was barely strong enough for 3. Certainly, numbers 4, 5, and 6 are gone. And no matter of temporary payroll adjustment or unemployment benefits is going to do more than provide a sort of a short-term sop to that. So the economy is going to change, and it will change in ways that we can't even really begin to fathom. So many jobs that were created over the past couple of years, I call were sort of societal indulgence jobs. In barbershops being one. I think in terms of all the casinos that are now in New England, there are 3 in Massachusetts. The two strong ones, Foxwoods and Mohegan Sun, down on Connecticut, down in northeastern Connecticut, and there's one in Lincoln, Rhode Island. Now, I certainly know that New England has plenty of room for gaming, and this is no commentary whatsoever on the social implications of it. But a lot of the Encore, which is the one that went in just north of Boston at Everett, to much fanfare. Tons of jobs created in the construction, tons of jobs created in the execution. Nobody can tell me that there's enough room for 6 casinos once everything reboots. One of the absolutes here is the savings rate in this country is going to go higher. We had, to put it in perspective, we had back in the height of the residential real estate, back to the tech bubble and then the residential real estate bubble from 15 years ago, we had a national savings rate of about 4%. People would save 4%, and that 4% became the basis of investment within the banking system. Well, after the great financial crisis, that 3-4% became 8%, meaning people were spending a lot less of their discretionary capital. Well, we're going to go probably to an 11 or even 12% savings rate for the foreseeable future, meaning that a lot of things that we've enjoyed spending our money on, very highly discretionary, I use the words indulgence items, are going to be put aside for a long time, maybe forever. There are some things that take a generation. I mean, the world changed drastically after 9/11. It changed drastically after the great financial crisis. It will change drastically after the virus is hopefully forever put to bed. But it will change, and one of the really interesting opportunities in the aftermath of all this will be to position client portfolios for the great significant positives to come. And so I will stop there. I'm sure I'll come back for the Q&A session. Thank you again for being aboard, and Peri's going to deal, as Ashley said up front. There's just a host of wealth planning challenges that are not just imminent but long term, and I turn it to you, Peri. Thank you.
Well, thank you, David. In addition to our investment team managing our clients' portfolios through these unprecedented times, our wealth management team has been working very closely with our clients on their overall financial plans. In our role as a personal CFO, we are making sure that the overall plan for each and every client is still valid and achievable. Our holistic approach to wealth management evaluates any changes in the investment portfolio in light of the bigger picture. In times of stress, such as we are currently facing, it is more important than ever to follow your plan and to not let emotions such as fear drive you to make poor financial decisions. Our team embraces these crazy times as an opportunity to work with our clients to review, modify, and improve their plans so they have a greater likelihood of achieving their goals. And as you can tell from David, we love what we do, and we really enjoy working with our clients. And the virus and everything that's going on right now is clearly an opportunity for us to help you do better in your life. We always are encouraging our clients to review their estate plans on a regular basis, but now is a great time to make sure that your beneficiary designations and the designation of agents in your powers of attorney and healthcare powers reflect your wishes. A lot of times when we're working with clients in their attorneys and putting their estate plans together, people put names in for the healthcare agent or for their power of attorney sort of as a place filler, thinking they're going to get back to it someday when they really figure out who they want. Now is a really good time to take a look at who you have there and make sure that they are the right people to handle those decisions when the time comes. It's very often that during these stressful times, people realize that the people that they've named aren't capable of fulfilling the duties that are going to be assigned to them. So I encourage all of you to review who you've chosen to make sure you're still comfortable. On the tax front, we believe that the massive stimulus is going to result in higher tax rates and a reduction of the estate tax exemptions in the near future. Whether it's in 2026 when they're scheduled to come back, or if we have a change in the White House, we're very confident that tax rates are going to go back up and the state tax exemptions are going to go down. When you combine that with the extremely low interest rate environment and the fact that a lot of asset values are depressed right now, this is a great time to consider transferring assets to your heirs on a very tax efficient basis. So we're working with our clients' estate attorneys and helping them use various gift planning strategies such as outright gifts, gifts into trust, intra-family loans, and even Roth conversions to get that wealth to the next generation. In addition, our KLR insurance team has been very busy reviewing life insurance policies owned by our clients, either individually or in trust. The current stock market conditions have the potential to negatively impact the performance of life insurance policies issued by life insurance companies that are publicly traded. As the market capitalization of those companies goes down, the life insurance companies are increasing the cost of the insurance in the policies, which will have a negative impact on their performance, and the goals that the policies were set up to achieve may not be realized. We have a great article on this subject on our website, and I encourage you to read it if you own any life insurance or are the trustee of a life insurance trust. Our entire team thanks you for your time today, and we hope you found this helpful. I'm now going to open this up for the questions. And David, I'm going to give the first question to you. One of our clients asked the question about the fact that we are experiencing what is known as a Black Swan scenario. And can you speculate on the impact on that, on investing post-pandemic?
So I'm going to actually come back to a shorter term. And the post-pandemic, as I sort of referred to a few moments ago, I think the opportunities are going to be tremendous. But let's sort of just deal with the here and the now from a markets. And I already sort of talked about it from an economy standpoint. Yeah, the Black Swan arrived. What's a Black Swan? I mean, I think it's now in the nomenclature. It sort of added to the financial world market nomenclature 12, 13 years ago when Professor Taleb from, I think he was an NYU professor at the time, wrote a book relative to the great financial crisis, how the residential real estate market's collapse was something that was totally unforeseen and almost brought the banking system, down and created a really, really horrible bear market environment, down 50-55%. Well, this, I made reference before that the economy needed a reboot. Who would have known? So the virus is clearly the Black Swan. It's, I use the genie metaphor. The genie's out of the bottle. The Black Swan is among us, swimming among us. And just really like we didn't know what the economic implications were going to be coming out of the great financial crisis. We don't know what they'll be coming out of coming into the post-pandemic world either. We can speculate, and I already did a little bit of speculation that the economy was going to change, and that many of the sort of the last few percent of GDP growth that was more of an indulgent world would disappear. Now, just because it disappears doesn't mean that those resources are forever go unutilized. That those people who were put to work in I'll say particularly the hospitality, leisure, and even some degree the transportation industries, intensely low wage work, are forever unemployed and unemployable. That's not the case whatsoever. You know, the opportunities for a rebuilding of an economic structure with, you know, I'll switch metaphors again. The forest fire. What does a forest fire do? It burns, it takes out a lot of acreage, but it really leaves the tall, strong trees standing and burns out the underlying flora and fauna that was clogging up the forestry arteries, if you will. That's what's going on right now. I mean, I don't mean to demean the virus as in any kind of glib kind of way, but that's the nature of all bear markets. All bear markets and all reboots of an economy, all recessions serve to eliminate excesses that were created and usually take the economy below where it should go to if it was just a normal equilibrium being established. What that does is creates opportunities. The opportunities are, in my opinion, very, very significant. I mean, among other things, and our host on the call, Ashley, she is a millennial, and I said to her as we were going in, Ashley, you are one of my economic heroes. I have a 34-year-old daughter and a 31-year-old son who are among a generation of 85 million millennials, much bigger than the baby boom generation, to which, you know, I am, Peri, you are, many of us on the call are. And our generation was magnificent during the decades of the 80s and the 90s, and really building a strong economy that lots of strong trees, very vibrant, very powerful, until we started making mistakes in the decade of the 2000s, frankly. And so we will come through this reboot. Our millennial generation will be that much older and wiser. The system will be well funded. One of the reasons I think this bear market found its bottom at that 35, 36, 37% drawdown level on March 23rd was the monetary response, because every economy, every market runs on fuel. And what's the fuel? Is money. The monetary and fiscal response has been unprecedented, much bigger than after the great financial crisis. And it took a while for the policy response 12 years ago to get going. Well, the policy response here was immediate and powerful. And that money isn't going away. You know, some of it we may find, as Peri, I think, alluded to, potentially higher taxation, just to sort of get us back to maybe more fiscal, a little bit more fiscal normalcy. We're going to run a budget deficit this year of somewhere around 20% of GDP, when we were running 4% last year, and really should be running sort of 2.5 to 3 on an ongoing basis. But the millennial generation, which I have absolutely every confidence is going to be nowhere near as transactional as ours proved to be, operating with a tremendous amount of capital behind it, I think we have the possibility for really, really strong financial market returns, not just a great economy, but the financial returns, the stock market returns that will go with it come 21, 22, 23. There will be cycles, there will be future recessions, but I think the opportunity is great. And one in particular, I read a markets, potential future manias. What's the next market mania? We found biotech stocks, we had personal computer stocks, we had .coms, we had residential real estate. And I think, we've announced and we're executing upon an ESG focus for many of our clients' portfolios, environmental, social, and governance. And we can come back to the S and the G at some point later. I don't think it's enough time allowed for this, but those investment opportunities that are focusing on climate change could just be magnificent. Now, what those will be, I don't know. Some are probably already out there. Some are being thought of now. Some are not even being thought of. But, the opportunities for returns in a resurrected post-COVID economy that is fully rebooted I think can't be ignored, cannot be understated. And I'm very excited about that. And I'm very excited about the millennial generation's opportunity to take this opportunity and really run with it. Now, in the meantime, I'll just come back to that. What are our targets? And I probably neglected to go for this. I think we have the market bottom is in at 18,000 plus on the Dow. I think right now with a 2,000 or so, almost 2,000 point retracement since April 28th, we're about 22.9, 22.8. I think that anything around 20,000 on the Dow is a fat pitch for incrementally, not precipitously, but incrementally adding risk to portfolios. So an S&P 500, which is now, I'm looking at a screen, so I'm looking away of below 2,800, got to 2,950, anything in the 2,500 area, for example. I think that is not guarantee that it's going to go that low. It may not, but that's a fat pitch opportunity. We're going to, for the time being, remain resolutely underweight equity targets, risk targets within our client portfolios, but looking forward to the time when we can be adding incrementally, just based on not just the short-term tactical nature of the markets, but also take advantage of the potential big opportunities ahead. Sorry, long-winded answer to a short question.
I think I'll take the next question. It's a combination of two questions we received. One question was, should I rebalance my portfolio in the down market? And the other question was, if you have a 2-year time horizon and are currently 65% equities, what is the best near-term move? Going back to what I said earlier about having a plan and sticking with it, that is true given the current market conditions. So if you've put together a plan that has an asset allocation based on your risk tolerance and your time horizon, and I'll talk about the time horizon in a second, then you shouldn't be making any precipitous moves. You shouldn't be trying to get out and get back in. As David has told me many times, if you look at the economic cycle as a clock and you're smart enough to be able to exit at 12 o'clock on the dot, human nature is that you're not going to be willing to get back in at 6 in the morning, even if you know it's 6 in the morning. With human nature is you're going to validate that it was 6 in the morning and you're not going to get back in till 9 or 10, which means you've lost a lot of opportunity. The way we manage our portfolios is we make incremental changes as we go through the economic cycle. So if tying that back to your time horizon, the person who submitted the question mentioned a 2-year time horizon. I'm going to humbly question the 2 years. In many conversations I have with clients, people say, well, I'm retiring in 2 years and that's my time horizon. Unless they think that the day after retirement, they're no longer going to be in this world, I would respectfully suggest that their time horizon might be 20 to 25 years, or put another way, their remaining life expectancy, and that their asset allocation should reflect being able to achieve their goals and maintain their lifestyle through the end of their life expectancy. So again, it comes back down to having a good plan, making sure that your asset allocation is consistent with your goals and your risk tolerance so that you can sleep at night, and sticking with that plan. Let's see. I'll give you a softball here, David.
Good.
What do you think of gold as an investment, and should I own it?
Okay, so gold is really interesting from lots of different respects. First of all, there's sort of an underlying cult of gold that exists. And so gold will always have a bid in the market. It will never, even though gold has, fundamentally, aside from some jewelry and some tooth fillings and so forth, there's no functional economic value to it whatsoever, other than what we attribute to it as a store of value. So having said that, gold has, in my opinion, in my 40 years, has careened between, the ideal diversifier is within a portfolio is one which you can count on to be totally uncorrelated with your other assets. It will do fine over time, but it will do fine according to its own clock, its own wheel, if you will. And when other assets are zigging, it will zag, and when others are zagging, it will zig, and so forth. But it will do so on its own. Gold has not been that asset class in really over my own near 40 years here. There was a brief period of time, I think in the early 80s, late 70s, early 80s, when it seemed to be that way, and it sort of developed its cult of ownership. And this was really coming out of the globe's dropping of the gold standard to base its currency value on. So there was a sort of 15-year window where it became an asset class of choice, and there was value to it. But over the past 4 decades, it has careened between being very, very much uncorrelated with being highly super correlated with what's going on in the world. Generally, there's not much gold. I think there's enough to fill an Olympic-sized swimming pool in the world right now, something like that. So there's not much gold. And so it really is the value that we place on it. And that underlying determinant is generally what's the flow of funds into assets, into markets as a whole. So gold has had a nice run here lately. Well, guess what? So has mother stock market. So there's no guarantee that if the stock market drops off here, and I say there's another question that we might get to, towards the end of this quarter and into the third, that gold is going to retain its value, because if there's selling pressure against stocks, particularly of any urgency, there's likely, no guarantees here, there's likely to be selling urgency against everything else too, absolutely, to include gold, to include oil, to include copper, to include all sorts of asset classes. So gold is fine. A small percentage, just because there is probably an uncertainty value one can attach to it. There's always a value. There's always a bid for gold somewhere. But I certainly wouldn't make it a major part of a portfolio, because there's no income attached to it. There are no cash flows, and it can be massively disappointing just when you want it to be good.
Thank you. I think that'll be a good segue into the other question that we received, saying, do you see a significant market drop at the end of the second quarter? Or if not, then when?
Well, I think the natural human inclination is to look to, because the last thing that we're all to some extent deer in the headlights during that period between February 12th, when the market peaked, and March 23rd. I mean, that was the quickest 37% drop I can remember. You even exceeded that of 87 with the crash of 87. And then it took March 23rd to April 28th, about the same period of time, to get back percentage-wise the loss, not in absolute terms. So I think I do think that rally, as I said before, was much based on the premise that there would be a V, or at least a kind of shallow U, which I don't think is possible. So I think I'm operating under the premise that we're going to retrieve in sort of a series of W down, W up, W down, just to use the letter alliteration again, to finally find an equilibrium. And I think the stock market is poised for some disappointment. And I think these past 3 days are setting the stage down to take the Dow back down into sort of a, it's 22 and change, almost 23 now. As I said, 20. If we get to 20, it's a fat pitch. I'm not sure we'll get that far. Markets are rarely that cooperative. So I think that would be, if one uses that phrase as optimistic for an entry point, I'm not sure that might be a little ambitious. But I think I wouldn't want to bet against another 10 or 15% retracement from here, which would take us down to the high 20s in Dow terms. And then I think depending on the context and the magnitude, the duration, the context, then we perhaps evaluate as to when we put a few more nickels and shekels back into a client portfolio stock positions.
So the follow-up question to that, and I'll ask you as a resident of Massachusetts, what implications does COVID-19 have on the markets and on the election, in your opinion?
Okay. All right, so I think we've talked about the markets, and so any political question obviously is all politics is really the third rail when it comes to financial market punditry. But the fact is that the markets and the economy have a very outsized political impact, particularly as elections approach. So we have a November election. As far as I'm concerned, that's unreschedulable. Primaries might be, but the November election probably is not. And let me just say, Wall Street's own view, from a Wall Street point of view, if many surveys were taken in say January, February, and virtually all of the surveys had a re-election of the current office holder at about 80 to 85 to 90% likelihood. And that was based on the strong economy, on the perception of a strong economy. Again, I'll question the resilience, as we're now finding out, of a lot of the sort of indulgence part of the economy that had developed. But never mind. The economy was arguably, and I've written about this before, was very, very strong going into the virus. And the stock market was making new highs. It was an easy Wall Street connection to make. Everything else irrelevant, that the existing office holder would be reelected. Now, as far as I'm concerned, no incumbent has ever been reelected when the economy is down. The jobless rate, one can make the argument that, and many do, that this will be a V or a quick U, and don't worry, all will be fine come October and into November. Well, I mean, I go back to 1992 when Bush Sr. became a one and done president. In 1991, there was a recession. In November of 1992, the economy was humming, not necessarily on all 8 cylinders, but on 7 of them. But nobody realized it at that point. And the challenger, Governor Clinton, made a great case of it's the economy, stupid, and won easily. I think it would be highly likely, I don't know. I think it's the potential is certainly there for a massive change of leadership in Washington. There are outsized political consequences from outsized events, and we clearly have an outsized economic event here. So I think there will be political consequences. And yes, I am from Massachusetts, for all that entails.
A question that I've been getting from clients a lot is inflation a risk? And if so, what should we be doing with our investments?
So that's, again, a fantastic question, and I think that story will play itself out in the next several years, but not right away. Is inflation a risk? Absolutely, but not now. I mean, right now, the biggest risk is we're still going through a very deflationary stage where a lot of capacity is going to be eliminated. A lot of these, unsustainable jobs, unsustainable industries, unsustainable companies, even within strong industries, because they had terrible capital structures and bad business models and potentially bad management teams, will go away. That process is just beginning now. In order to get inflation, you have to have too much demand for the goods you have available. Well, right now we have almost no demand for a massive amount of goods. And it's going to take some time. That doesn't happen overnight. You don't reboot an economy overnight. It takes time, particularly with all these stimulus packages that are designed entirely to prop up the businesses that are there. I mean, that's the right thing to do from a social and human point of view, of course. There's no question about that. But it does sort of delay the inevitability, at least for a couple of months, of the shakeout. So I don't think inflation is a factor whatsoever in the next year or so. But at some point, when the economy has fully rebooted and all this money sits, the definition of inflation is too much money chasing too few goods. There will be an overshoot, an over rebooting. Things will go out that probably shouldn't go out and should come back. And in the meantime, the massive stimulus that will be generated, that's from the money that's already there, but from a rising demand, even though it'll look different, and we don't know how different, will generate more demand for the goods that we have, and prices will go higher. So yes, inflation will return. Will it go back to a 70s kind of inflation? Probably not. But inflation will return, and that will have massive implications, of course, for not just stock portfolios and how you position stock portfolios, but also how you position the fixed income portions of it. But that's a story for a year from now, a year and a half from now. So yes, inflation will come back, but I can't imagine it's going to be anything more than a promise for the next 12, 18 months.
Following up on the comment you just made about positioning the fixed income side of a portfolio, with interest rates essentially zero, how do you incorporate fixed income into the portfolios?
Well, fixed income is the great diversifier. I mean, there's basically, in my opinion, there are four fundamental asset classes. There's stock, there's equity, really, and in our world, that's stocks. But it's a business that is owned, and this would, we have many clients, I'm sure, out there who do or have owned businesses. They have equity ownership in a business, in an enterprise. We do it through the public stock markets. So you can own something with your money, or you can lend it to somebody, which is essentially putting money in a bank. You're lending it to the bank to do stuff with, or you're buying a bond. And there are zillions different flavors of bonds. Or you can buy real estate, that's a valid asset class, or you could buy commodities. Cash is sort of the low end of the bond side. So they are all, in my opinion, very, very valid diversifiers for an asset class. Bonds right now have, in my opinion, very limited to zero investment strategic or tactical investment appeal, except as a diversifier. If interest rates rocketed up tomorrow, bonds will on the face suffer losses. Principal values will temporarily go down, but nothing compared to what stocks do. So yes, we maintain a very strong fixed income weighting in our portfolios, not so much for the income that they create, although there is some, which is good, but it's more as a diversifier against the real volatility that comes at you from stocks. Of course, the real volatility comes at you from oil. I mean, it wasn't that long ago where oil traded to negative terms. It's now back at what, $25 a barrel or so for West Texas Intermediate. But if you really want a wild west in terms of markets under stress, there's nothing like the commodity markets. So bonds are an excellent diversifier. At some point, again, might be 3-4 years from now, they will be a wonderful source of cash flow and of income. But that's, in my opinion, still a ways away.
I'm going to address a couple of issues on the planning side for clients of ours that have retirement accounts. Want to make sure everybody is aware of that under the CARES Act, that you are not required to take your required minimum distribution in 2020. And if you have taken it already under certain circumstances, you can actually put it back. And one of the other recent tax law changes that came through is that you do not, if you weren't 70 and a half by December 31st of 2019, then you do not need to begin your required minimum distribution until you are 72. So when doing the planning that we do with our clients and we're looking at how assets are going to last into retirement, we're always looking at the balance of taking money from retirement accounts and non-retirement accounts, and making sure that we're managing the tax ramifications of where the money that our clients are living on comes from. So those are a couple of positives that have come out of this. I think, David, we've hit most of the questions. Is there anything you wanted to close with?
I mean, people could probably see my eyes averting. I have my another laptop set up with all sorts of screens with ongoing market action, and so this is what I do. It's a passion for me, studying markets, studying the connection between markets and economic activity and prospective economic activity. Nobody can tell the future, and particularly in a world where where it's something that's out of anybody's control is the dominating factor and is likely to be a dominating factor for many more months, if not quarters, and hopefully not longer than a year from now, hopefully. This is a passion for me. I'm always looking for signals that are sustainable. Right now I've sort of provided what we think is the more likely scenario of markets that adjust to an economy that itself still needs to reboot and reboot fully. It doesn't necessarily mean that the markets won't go down to a new low, although again, I'd be very, very surprised if they do. And it doesn't mean that the fat pitch at 20,000 will be realized, that we'll get that chance either. But one thing that I can say is that markets change every day. I mean, we have wonderful client. I've said this for the 40 years I've been in the private wealth business, working with just so many fantastic colleagues and clients and friends, who I've come to become very close with, who just know so much more than I do in this business. The relationships develop and get deepen. But they don't really change in terms of, except they get better and better. Well, the markets change every day, so it's a passion for me, and their perception changes. I've learned a long time ago to respect the truth of the last transaction, because I'm just watching my primer employer, Bank of New York Mellon, just last traded at $32.23. That might be the right price for tomorrow or the next day, but it might not be. But it's the price that cleared the last transaction. A real buyer with real cash buying with real cash from a real seller who's going to take that cash. One has to respect the price action in the markets as being potentially very, very valuable. It cannot be ignored, but we cannot be a slave to it either, just because, as I said before, markets can change and perceptions can change quickly. So I think the opportunities that we have here, we've already, I think, positioned our portfolios terrifically well by being underweight, going into something we never knew was coming, but the reboot was needed. We're getting it, and now the opportunities to provide significant value during this series of economic sort of stabilization, reemergence, whatever we'll call it, and then through into the next bull market growth pattern is significant. And thank you to, I'll just say again, thank you to our clients for being on board with us and giving us the opportunity to work with you on your wealth planning and goals and objectives, and the chance to manage your portfolios to accomplish those objectives.
David, we have one more question that just came in, and I think it's a good one because it's one that I know that you're passionate about. The question is, can you comment on dividends? They seem to be disappearing.
Disappearing is a little bit of an overstatement, but the point is well made. A couple of high-profile companies, for example, Walt Disney, just suspended its dividend. I think there have been a handful of and dividends matter in a world where the 10-year Treasury is yielding 50, 60, 65 basis points, and the dividend yield on the S&P 500 is up, well, now quite significantly over 2%. Pre-dividend announcements. That's a big deal. So many stocks actually over the past year or so have been bought for their dividends, for their cash on cash flow, and so forth. So yes, in a recession, dividends are always under question. And I look at Simon Properties would be a perfect example. I'm a big mall owner, stock I follow just as a general sense of what's the sort of the temperature, how does the market feel about retail? It has a stipulated yield now of 16.26%. There is no way that dividend of $8.40 on a $51 stock price is going to be maintained. So the fact that dividends will be cut and suspended is absolutely already in the price of many individual stocks and therefore in the price of the markets. Now, can it get, if we indeed get the L shaped economy, then a lot of these dividends are going to, I'm not sure they'll go away. They'll do what Disney did to suspend it. Obviously, Disney has lots of discretionary demands on its cash flow, corporate cash flow. But many companies will cut, and it will be a long time before they reestablish the dividends. But I took heart from Caterpillar Tractor several weeks ago, announced that they were retaining their dividend. Now there's a company that will be massively affected by the demand for its products at the industrial level and the global industrial level, and they maintain their dividend. A couple of major pharmaceuticals, Lilly, Johnson & Johnson, increased their dividend. So yes, dividends absolutely matter, but at least at the moment, I'll push against the premise that they're disappearing. I think there will be further cuts. There may well be a further suspension, but I think the market is already, highly aware. And let me just add one other thing. This is back before I got in the business, back in the early 70s. I think the big, and nobody knew it at the time, General Motors at the bottom of a recession, I think 73, 74, cut its dividend. And I think this was late 74, or eliminated its dividend. And at that point, as goes GM, so goes the nation. GM cut its dividend or suspended its dividend, and that was the day the stock market bottomed, when all the bad news was in. So again, whether that happens this time, whether there will be such a high profile bellwether dividend wise to, that we can then look back 5 years from now and say that was it, I don't know. But yes, dividends matter, but I think the really scary premise is unlikely to be realized. And it's already largely priced in.
All right, so I think that gets us to the point where, Ashley, you want to conclude for us?
Yes, thank you both. That was excellent. And thank you everyone for joining us. That pretty much wraps up the formal presentation. If anyone has a last minute question they want to send in, feel free. Peri and David will stay on and answer that for you. But thank you again, everyone, for joining us. And we'll be sending out a recording of this session afterwards. KLR, our sister company, has also created a coronavirus resource center, and the link is here on the contact slide. We are writing articles and adding to this daily so that you can stay informed on the latest news and developments regarding COVID-19, their impact on your business and the global economy. There are also a number of resources that Peri had mentioned during the presentation on the KLR Wealth site, and the link is here to their insights page. We understand that these are difficult times with many uncertainties, so please feel free to reach out to us if you have any questions. We are here to help. So thank you again, everyone, for joining us. I don't see any additional questions coming in, so have a great day, and that wraps things up. Thank you, Peri. Thank you, David.
Thank you.
Thank you all.